Welcome learners to Commerce Gyan, and today we are going to start with our third part of Basics of Accounting video series. This particular series is available in the form of a playlist. You can go from part 1 to the end part of the series if you wish to learn the entire basics of accounting. So in this part 3 of the video, we are going to talk about a very important thing of accounting, and that is what is the types of accounts and the golden rules associated with accounts. Now remember, in accounting, types of accounts is a very vital and essential portion and part of your syllabus, or part of, you can say, learning accounts. If you know the types of accounts and if you know the three golden rules of accounts, you can say that the major portion of your accounting will be clear. So you will not have difficulty in writing journal, ledger, trial balance, or even preparation of the balance sheet if you have the basic clarity of these types of accounts and golden rules which are associated with the identification of what will be debit and what will be credit in accounting. So that is a very essential portion. So this particular video you can keep as a saved video and keep revising this every now and then, because it is something which you have to remember for your lifetime. You cannot forget these types of accounts and golden rules if you are associated with commerce. Okay, those who are going to use this video for learning of types of accounts and golden rules, we have some practice questions which we are going to solve at the end of this particular video. And since we are answering the questions in the video, you will need you can say a reference for questions. And that is what I've given provided in the format of a PDF, which you can download from the description in this particular video. So in the description, you will have a link which will take you to the downloading part of the notes. So that will be a PDF for the questions which we are solving in this video. So let's proceed now to understanding of types of accounts and the golden rules which are going to help you in your onward journey in accounting. So let's proceed. So what are these three types of accounts that we need to understand is basically these three things: personal, real, and nominal accounts. By and large, you will see that accounting revolves around these three accounts. So most of the accounting entries and everything connected to accounting will revolve around these three accounts only. So if you're clear about the meaning of these accounts, what is, you can say, the rule associated with this account, whether a debit is to be done in a particular case, a credit has to be given in a particular case, then you will be absolutely clear in, you can say, going forth and preparing the balance sheet. So up to the balance sheet, everything will revolve around the, you can say, these three rules of accounting, or the three accounts and their rules. So pay careful attention to each and every part of this particular video. Now, what we have first is the personal account. Now, what is a personal account? Personal account is, as the name suggests, personal, person, right? So it is associated with a particular person. It is associated with what we say as an actual person. That means it could be a name. It should be like, you can say, any name you take of your friends. Let's say Dipti's account, Megha's account. You can take the names of other people, like you can say Mr. Kumar's account, Mr. Mohan's account, and so on. So it's basically, if you see the English language, we say proper noun. Correct. Proper noun means what? There is no other person or entity except for this particular person with that name. So that name represents a particular person, and we say that this particular account also, the personal account also, is connected with a person. So this is where we see the first part, that is the person would be an actual person. Secondly, if you see the details given in this particular definition, you will see that the person could be an actual person or an artificial juridical person. What do you mean by artificial juridical person? It means that it could be an entity which has its own existence in the eyes of law. Now, suppose if you take the example of any bank, let's say Bank of India or State Bank of India that we commonly see around us. These banks are basically having their own entity. They are registered entities in the eyes of law. So their owners, the managers, employees, everybody is separated. So Bank of India will remain Bank of India as it is for its entire, you can say, infinite time period, as we have seen in going concern. So it will remain Bank of India, even if a particular owner resigns or another person takes up the management of that organization. So it will not lose its existence. So that is where we can say that they are an artificial juridical person established in the eyes of law. They have their own existence in the eyes of law. Take example of different companies, right? If you see any kind of company like Tata Motors, or you can see Reliance Industries, you will see many other companies who are registered in India. So it could be Hindustan Unilever and so on. So all these companies are having names. They have their own existence in the eyes of law. So once I say Hindustan Unilever, you know that it's a company. It's having its own existence. Can this company give you loans? Can the company sell you products? Can the company buy from you? The answer will be yes, because it has its own existence and it is separate. Have the ease of transactions. They have the same, you can say, existence like a human being. So they are actually in a position to sign contracts with other people. So this is where law gives them a separate existence, and they have their running, management, everything under their own, you can say, existence. Fine. So these companies, these organizations, it could be a trust, it could be a company corporate existence, it could be public, you can say, property, or it could be like a local authority, a corporation like PMC and all that. So these are basically, you can say, the second classification, like which comes under personal accounts. So personal accounts is basically having artificial juridical existence, or it could be a normal existence of the human being. Now, third things, if you see in this particular part, is also these accounts could be representative accounts. What is a representative account? Now, representative account, I'll give you a simple example like a capital account. Now, capital account, if I say capital is what, if you remember in the first video we discussed, capital is something where you have the amount invested in the business. Suppose I am starting with a business, what do? I invest some money into the business, but my money is treated as what? As capital in the books of accounts in the business. So when I'm saying capital, what is this term capital associated with? It is associated with me as a person. So though directly the name is not existing in the capital account itself states that it will be given, or you can say invested by a person, a personal account, right? So capital account is also to be treated as a personal account. Remember this. So this is an example of what we say as a representative account. All these three, a normal human being's account, an artificial juridical person's account, and a representative account, all three fall under the same definition of personal accounts. Fine. Now, rules of these accounts, we will, if we have to see for personal account, in dual entity concept, if you remember the concepts of accounting, dual entity concept or dual aspect concept. In this dual aspect, what do we have? We have debits and credits. And we said that every debit will equal a credit. Fine. Now, in this case, it's not necessary that all the debits and all the credits will be of the same account, that is personal account. This will, you will get it when we solve the examples. Don't get confused right now. Just understand that for a personal account, the rule of personal account says debit the receiver and credit the giver. So if a person is getting something, money, goods, whatever. So if the person is getting something, his account will be debit. Fine. And if the person is giving something. Like suppose the owner is investing money into the business, so he is giving. So his account, his capital account will be having a credit. If the bank is giving a loan to the organization, that loan given to the organization by the bank is the giver. So the giver's account is what? It is credited. So debit the receiver and credit the giver. This will be the rule of personal accounts. Fine. So once you've understood the rule of personal account, we move on to the next type of account, which is the real account. Real account is talking about assets and properties. We already know that what is an asset and what is a property by now. So what is our next job is to understand that these assets or these properties could be tangible or intangible. What is a tangible asset now? Tangible asset is something where you find that you can touch and see that particular asset. Suppose you're talking of a building. Can you see a building? Can you touch a building physically? Yes. If you see machinery, yes. If you find printer is there in your office, you can actually see that particular printer and it has some value which will be recorded in the books of accounts. So printer will become a real account. Okay. Any kind of building will become a real account. Now, if the question would be like, isn't the building a personal account? No, building is not a personal account. The organization which will be running in that building will be a personal account. So if that building is of Infosys Limited, then Infosys Limited will be what? A personal account. But the building, the address, that particular structure is not a personal account. It is basically an asset and it has a value in the books of accounts and it will be treated as real account. Cash account. Cash you can see, right? You can see money. You can touch the money and you can trade in that money. You can give the money, take the money. So this money becomes the tangible asset. Tangible means you can physically touch and see that particular asset. Fine. So we have tangible assets which will fall under what type of account? Under real account. Then we also have intangible assets. Those which we cannot touch and see and feel, but actually they have a value. Actually they are known, they have some particular monetary value. Now, if you remember, we find that, okay, there is a specific name of or a brand that you like. Suppose you want to buy a soft drink. You will say, okay, I want Coca-Cola or I want Pepsi, right? Why do you choose Coke or Pepsi? Because they have a reputation, correct? Tomorrow, if I say, okay, there is ABC or some XYZ name of a soft drink, and you buy it. Say fresh soft drink. Will you buy it? So you'll say, okay, I don't know whether it's good or bad, correct? I don't know whether that brand will give me the quality which I expect. So I will prefer to go for Coke or Pepsi, right? So why are you going for that? Because that name, that particular identity of that particular brand has some valuation. And this valuation is what we call as goodwill. The name is having some goodwill in the market. So even in your case, people around you, if you are good with them, if your network is fine, you have earned a name in the group of people, they say, okay, you have goodwill. You are known well as a good person in that particular society. So goodwill is something which you have, you can say, a good name, a reputation, a brand in the market. So that is where we find different branding of products. Like if you see different associated brands also, you find in clothing brands, you find in machineries. Like if you want to buy let's say a washing machine, you'll say, okay, I will go for an LG product, or I will go for some specific product, any product. So I'm just taking a few names of brands. It could be any brand. Why you are paying more? Because you have that particular specific reputation in the market of that brand. And that is what we name as an intangible asset. It also has value. Now, there could be other examples like a book is written by somebody and the author of that book has a copyright. You cannot just publish a book of the same content in your name. Can you do that? You can't. Why? Because that author has a copyright. You cannot copy the book as it is. That particular author has the reputation, has the rights on that particular book and content. So those rights that are having some value. So tomorrow, if suppose they want to sell the content to somebody else, what will they do? They will take the money against the rights of the usage of that content. So that monetary valuation that you can get against the rights is basically what we will account, right? It has some monetary conversion. So those rights, which we call as copyright, are intangible asset, and that also is classified under real accounts. There could be many more examples like trademarks. You will have patents, right? So engineering goods may have patents. So patents have a right of usage, and you can charge for a patent. You can charge for your trademark and so on. Logos, correct? So all these will be falling under the head of intangible assets. So hope that is clear that we have tangible assets and we have intangible assets, and both of these type of assets and properties will fall under real accounts. In this, the tricky part is cash accounts. Just like we had the tricky part in personal account, which was capital account, it's a little bit tricky. Capital account, you may say, no, I don't know which account it is. It is but a basic, you can say, personal account, because there is a name, there is a owner's, you can say, connection associated with that. So that is one thing. In real accounts, the tricky part is cash account. So if you get confused, just note down that cash account will always be a real account. Fine. So real accounts, assets, and real accounts, you will have one part is tangible assets and second part is intangible assets. Then we have the rule of this real account. Rule of real account is simple. It says debit what comes in, credit what goes out. Debit what is coming into what? Into the business. So wherever we are applying these rules of accounts, remember the application is surrounding the business. Business is the center point. And then we are saying, okay, asset is coming into the business, then it is debit. Asset is going out of the business, then that is credit. Fine. So if you pay cash, what will happen? Cash is going out. So according to this rule, what happens? Debit what comes in, credit what goes out. So if cash is being paid, it is cash is going out, it will have a credit. Okay, so the effect of that transaction will be a credit. Debit and credit we have applied. So hope real accounts and the rule of real accounts is clear a little bit at least, because further we will take a lot of questions and illustrations which will make this particular concept clear. So at the end of the video, we are going to take a couple of, you can say, illustrations which will help you understand the types of accounts, and they will also help you to clarify what will be the debit and what will be the credit when you apply the rule of account. Fine. Let's take the last account that we are going to learn in this particular video, which is nominal accounts. Now, nominal accounts are very simple to understand, because we are saying nominal account says all the records related to incomes, expense, profits, losses, gains, and in fact other losses associated. So all this will fall under the head of nominal account. So if I pay salary, salary is expense, it is nominal. If I am paying for commission, it is nominal because it is expense. If I am getting any kind of, you can say, commission, then commission will be falling as nominal account, and so on. So different parts of nominal accounts is income, expense, profits, gains, right? So remember this. Now what is debit, what is credit for nominal account? Nominal account says all expenses and losses are debit, right? All expenses and losses are debit. And what is credit? All incomes and all profits, all gains will be credit. So this is very simple, because debits are all expenses and credits are all incomes. So if you remember this, you remember the nominal account rule. So 3 rules, 3 accounts which we have learned. Keep a little bit of more, take a little bit of more revision, And then you can proceed to the illustrations part of this particular video. When we learn in the illustrations, you will understand more clearly, and I will be explaining more and more in when I'm solving the illustrations associated with this particular types of accounts. Fine. So let's proceed to the illustrations. You will find there are two illustrations which we are going to take up in these videos. This is the first illustration. You can, if at all you want, you can take a screenshot of this illustration and this second illustration, or you can download the PDF given in the description of this video. Right, so description of this video also has a PDF link. You can download that PDF for these two illustrations, or you can take a screenshot of these two illustrations, save it for your own purpose, and then we can solve the these two illustrations. Fine. So let's proceed to the solution of this illustration 1. Okay, we are taking the first illustration 1 from the PDF, and what have they asked us to do is, from the following, identify the different accounts in the transaction, classify them into types, and suggest which should be debit and which one should be credit. So basically our job is of three things. One is to split this particular transaction into basically two or three or whatever, four parts. Whatever the transaction has number of accounts, we are going to split that transaction into different accounts. And then once that is done, we will classify that account as personal, real or nominal. Once classified, then next step is to find out whether we should debit it or credit it based on the transaction. So in this manner, let us now solve this particular illustration 1. So we take this first transaction. Manu started business with cash rupees 1 lakh. Before we really start with all the illustrations and these transactions and split them and do all the activity, there is a base concept that you need to understand, which will again lay one foundation stone for your accounting. Now, what is this base concept? First important thing you need to remember, whenever you do any transaction or wherever transaction is happening, it is from the point of view of business that you are going to write the accounts. So when I say Manu started business with cash, some may feel confused that, okay, Manu has started business with cash means Manu is the investor or Manu is giving money, getting money. They will not understand what is happening unless and until you focus on business. Remember, our point of view is business. So what is happening in this case? Manu is an outsider for business, though he is the proprietor or the owner of that business, yet for accounting purpose, Manu is an outsider. Remember this. So this is the basis of every single transaction. If you forget this, you will forget everything in the further points. So Manu will be an outsider, and what is he giving to the business? He is bringing in cash. Okay, so cash is being given to the business. Now, who is writing accounts? Business is writing the accounts. Correct. So when business is writing the accounts, every single transaction happening will be from the point of view of business. Imagine yourself to the business, yourself to be the business. What happens in this case? Manu is giving you money. So as a business, what would you do? You would say Manu is somebody who is giving the capital to the business, and second is cash is coming into the business. Got it? So in this way, now based on these points, we are going to write the accounts. Okay. So let's proceed. So now we proceed to illustration 1, the first transaction. And then we will do our activity of splitting the transaction into different points. Now, illustration 1, the serial number 1 says Manu has brought in cash for the business, right? So Manu is starting the business with cash. Now, what is happening in this is, first part of us is to split this particular transaction. The first part of the transaction is Manu is the owner of that business, Manu's capital account. How will business write the money given by Manu? Business will say Manu's Manu's investment in the business is the capital invested in the business, right? So for a business, Manu is an outsider. Manu has given what? Capital to the business. So that is the first part. Now, how is the capital coming into the business? The capital is coming into the business in the format of cash, right? Capital account, if you remember, was a personal account, right? Representative account or name, right? Manu's capital account. Even if I don't have the name in it, it is obvious that that account is related and relevant to a person. So Manu's capital account will be a personal account. And what about cash? Cash is an asset, cash is a property. So cash will be real account. When I write account, I put it as A/C. Fine. Now comes the part of application of the rule of accounting. How is the rule of accounting done? What is the account? Personal account. Now you have memorized the 3 rules of accounts. Try to recollect. What does personal account rule say? Debit the receiver, credit the giver. Who is the receiver in this case? There is no receiver. In this case, for the business, Manu is the giver of money. Correct? We are writing the accounts from whose angle? From the angle of business. Business will say, okay, Manu is the giver to the business. So business will write this as the Manu is giver and giver's account will be credit. Credit is also written as C/R in account. C capital, R small. Now look at the other part of the transaction. Other part is cash account, real account. Real account rule says debit what comes in, credit what goes out. What is happening in the case of business? Cash is coming into the business. So every transaction I am pointing out from the angle of business. Business finds that cash is coming into the business. So real account says debit here. D small r is the short form of debit. So basically we are saying that cash is coming into the business. So debit what comes in, credit what goes out. Applying that rule, cash is coming in, it is debit. So hope the first transaction is understood. Now second, if you see second one, what is this illustration saying? Cash deposited into bank. Forget the amounts right now. We are not concerned with amounts. Only thing, cash deposited into bank. Now, what are the accounts involved in this particular transaction? Accounts involved will be cash account because cash is deposited. And second account, where is the cash deposited? It is into bank. We are not given the name, but we know that it is a bank. What is cash account? We know cash account is a property. It is a real account. And what about bank? We know that bank has a name always, right? It could be a State Bank of India, Bank of Maharashtra, ICICI Bank, whatever. We don't know. But bank account will be a personal account because bank is a registered entity. So this account will be personal account. Again, apply the rule. Real account rule says debit what comes in, credit what goes out. For the business, what is happening? This cash is coming into business or going out from the business? The cash is going out from the business because it is going into the bank, right? So cash is going out from business. So cash account will be credit. Debit what comes in, credit what goes out. It is going out. Bank account is personal account. What is the rule of personal account say? Debit the receiver, credit the giver. Is bank receiving the money or giving the money? In this case, the business is going to the bank and it is depositing that money into the bank. So bank is the receiver of money, not the giver, right? Bank is the receiver. So debit the receiver of the money. So you will see here that as soon as you are able to draft, you can say, or split the transaction into different accounts, you know what type of account it is. It is very easy whether it should be stated as debit or credit because you know the 3 rules of accounts. Next transaction, cash purchases. So cash purchases is the only thing given, cash and purchases. So splitting it, we will write first account is cash account, right? And second account, in this case, purchases means what? Purchases means it is connected to the goods. which are bought and sold by the business in the short run. That means day-to-day transactions of business. So here we can also write it as goods account, right? Or into brackets, I'm just putting it for your information, purchases account. Now, cash account is real account. It is basically, by now we are aware that it's a real account, property. Goods account, goods are also a real account, isn't it? Correct? So goods account is basically real account. In this case, cash is coming in or going out. Cash is going out because you're buying goods. So cash is going out, credit. And goods are coming into the business. Debit what comes in, credit what goes out. Fine. So in this way, we can apply the rule of real account in both cases. Now, some people may also classify purchases to be expense. Even if I put this as a nominal account, what will happen here? Nominal account rule says debit all expenses and credit all income. So in this case, is purchase my expense or income? It is expense. So expenses will also be debit. So equivalently, it will have the same effect. Technically, purchases means we are talking about goods. So I am taking it as real account. Fourth one, let us take the fourth one. Here there is some serial number mismatch, but anyways, we can take this transaction to be the fourth transaction. Goods sold on cash 2000. So I'm putting here as date is 5th. We don't have any transaction on the 4th date. So I'm taking it as 5th only. There's no transaction. So leave it. Leave the 4th transaction. 5th transaction that they have given us, goods sold on cash. Let's take that. Goods sold on cash. Goods and cash are the two accounts. Goods account and cash account. Goods account, real account. Cash account also, real account. I hope now you're clear. Goods are coming in or going out. Goods are sold. So in this case, I can also put this as sales account for people to understand better ahead, because in journal, we are going to write it as sales and purchase. So here I'm writing as sales account. Now basically here goods are coming in or going out, goods are going out. So debit what comes in, credit what goes out. So credit, and cash is coming in. So debit. Debit what comes in, credit what goes out. Sixth transaction. Sixth is bought furniture. So what is being bought now? We are not buying day-to-day products or goods like sales and purchase. What are we doing here? We are buying an asset which is going to be with us for a longer duration, and that asset is furniture. So specifically we write here as furniture. Furniture account. Now furniture is bought. They are not given us how it is bought. So whenever in accounts nothing is specified, we assume that the transaction was made on cash. Unless and until a name is given or something is specified, we assume that the transaction was made in cash. So furniture account is real account. Cash account is also real account. So furniture is coming in, cash is going out. Debit what comes in, credit what goes out. Fine. Next, seventh. Purchased goods rupees 2000 worth from Martin. Now this transaction, pay attention carefully. See, as I told you earlier also, accounting is an art. It is not maths. So here we have to analyze and understand what is happening. Purchased goods from Martin. So Martin and goods are the two parts in this transaction, right? Martin is the person who is giving us goods, and purchases is the purchases account, or in this case, I'm writing it as goods account, right? So Martin is the giver of the goods and we are buying the goods. Why am I not taking cash? The reason is because there's no mention that cash is paid. Now you would say here also there was no mention of cash is paid, then why am I taking, why am I assuming it? Because furniture they are saying is purchased. Have they given you any name? No. If no name is specified, then we assume it as cash. But if a name is specified and there is nothing as mentioned as paid or cash or bank, then we assume that it is on credit basis. The amount will be paid later. So here now Martin's account will be personal account. And what about purchases or goods account? We are taking it as real account. So Martin is the giver, giver's account credit, purchase of goods debit. Fine. So one transaction, one part of the transaction is debit, one part of the transaction is credit. Eighth point says withdrawn from bank 500 for office use. What was the use? Office use. So what you can do is basically you have two things in this. You are withdrawing from bank cash account and bank account. Then see here, if it was given for office use means it is like spent on office expenses, paid for repairs, maintenance after withdrawal, nothing is given. If they are saying just I withdrew from bank for office use, not for personal use, but for office use. So this transaction is basically connected to cash withdrawal. Cash account and bank account will be the two accounts. Cash will be the real account and bank will be the personal account. So cash account, real account, is cash coming in or going out? It is coming in because you're withdrawing it. So debit what comes in. And what about bank? Bank is the giver of that money. So credit. Personal account rule, debit the giver, debit the receiver, credit the giver. Ninth. Paid to Mandira 1200. What are you doing now? Paid. Paid means either it will be paid in cash or bank. When nothing is specified, we have to assume it is in cash. Okay. Cash and Mandira. So these are the two accounts involved, cash and Mandira. Cash is real account, Mandira is personal account. What is the rule of real account? Real account says debit what comes in, credit what goes out. Cash is paid, so cash is going out, so I am going to credit. Mandira is the receiver, so debit the receiver, credit the giver. I am going to debit Mandira's account. She is the receiver, right? Next, 10th transaction here, goods worth 400 withdrawn by Manu for personal use. What is happening? Goods are there and Manu is withdrawing the amount. Now, whenever an amount is withdrawn from the books of accounts for personal use, the name stated is drawings. Drawings account. Remember this. So as and when we will be solving some journal entries and such transactions, you will come to know the names of some accounts, and meanwhile I will also explain what they are. So drawings account means it is the opposite of capital. Basically capital comes into the business and the amount of capital which is taken away from the business will be your drawings. So what is this? This is exactly opposite that. It is a personal amount withdrawn by the proprietor. So it's as good as drawings would be connected to a name, the capital account, right? It's connected with capital account only, the name, it is a representative account. So goods are real account and drawings, I will always take it as personal account. Now what is happening here? Goods account, goods are coming in or going out? Goods worth 400 are withdrawn. So they are going out from the business. Debit what comes in, credit what goes out. It is going out, so credited. Drawings account or capital account, personal account, is the person receiver or giver in this case? Receiver. So receiver's account is debit. The goods are being given to proprietor. So Manu is getting this particular amount of goods, personal account, debit. Fine. Next. 11th. Paid wages 800. So again here two accounts, two parts of the transaction wages account. What is paid is wages, and since nothing is given, I am assuming it is paid in cash. Wages is expenditure, so expenses are nominal accounts, cash is real account. So wages is nominal. Nominal account rule says debit all expenses and losses and credit all incomes and gains. So wages, expense, debit. Cash is real account. Real account rule says debit what comes in, credit what goes out. Cash is going out from the business because you are paying the amount. Cash is going out, so it is credit. Fine. So this is illustration 1. Now we are going to proceed to illustration 2. In the same way, we are going to solve illustration 2. Take the illustration 2 in your PDF, or as I told you, screenshot which you had taken earlier. And in this, now take the first serial number. Now here also there will be some mismatch because we have the fourth entry we don't have, but still just bear with it. Just focus on this particular number and the transaction. So first serial number is saying commenced business by Shiva with cash and laptop worth 30,000. So what is happening here? Shiva is commencing business. So we have Shiva's capital account. Whenever business is started by a person, the word capital will come into picture. So Shiva's capital account. What are the other two parts? What is he bringing into the business? Business is getting cash and laptop from him. So what are the two things he is bringing in? Cash and laptop. Okay. Now Shiva's capital account, personal account, we know that cash is real account. And what about laptop? Laptop is an asset, so assets account are real account. Now here you will see one is personal and there are three parts of this same transaction, right? Now let's see what is debit and what is credit. Shiva's capital account, business is getting the money and the laptop from Shiva. So Shiva, is he the giver for business or the receiver? See, business is getting money, right, from Shiva. Shiva is an external party and Shiva is giving some money to business. So for business, Shiva is the giver, right? I'm right, just putting it for your reference, giver. So giver's account is what? Credited. Correct. Cash is coming into the business, so debit. Laptop is also coming into the business, so debit. Fine. So this is how we applied. We split this transaction into different accounts. We had the types of accounts, applied the rules and saw what is debit and what is credit. Second transaction, bought goods from Jyoti. Bought goods from Jyoti. So Jyoti's account, Jyoti is a person who is supplying the goods and we are buying what? Goods, or in other words, we are purchasing some goods. Purchases account, we can say. Goods, right? Now what is Jyoti's account? Jyoti is a name, so personal account. Purchases account, goods account, I'm treating it as real account. Jyoti's account, Jyoti is giver or receiver? What goods from Jyoti? What goods means Jyoti is the giver. Giver's account is credit. What goods? Goods are coming in. So debit what comes in, credit what goes out. Applying that rule, I put it as debit. Third one now. Third is saying sold goods to Deepak. Sold goods to Deepak. So Deepak is one account in this transaction. And what are we doing? We are selling goods. So sales account as we call it. In other words, goods. Right? Deepak is personal account, goods is real account. Apply the rule, debit the receiver, credit the giver. Deepak is the receiver, so debit. Sales or goods account, real account. What is it? Debit what comes in, credit what goes out. Are the goods coming in or going out? Goods are being sold, so sales will be credit. If we treat sales as an income, income is nominal account. So nominal account rule also says income will be credit. So effectively, we have credit only. So whatever you take, it's up to you, no problem. Fourth one now. Fourth, we don't have no transaction given on fourth. So fifth serial number we take. Fifth serial number is what? Paid Jyoti 3,800 in full settlement of account. Now see, watch this transaction. Jyoti has goods supplied to us at 4,000. So we are supposed to pay, we are to pay Jyoti 4,000. And we paid how much? 3,800. What is this 200 now? This 200 will be treated as a discount. Why are we not treating it as a loss? Because sometimes business agrees upon to actually take some benefits, right? So basically, Jyoti is giving us the benefit of this 200 because we are using the word here as full settlement of account. So Jyoti has full settlement of account. She has allowed us to pay only 3,800. So what we have here first is Jyoti's account, fine, and we are paying her, so cash account. We don't know whether it's paid by cash or bank, but we assume it's on cash. And what about this differential 200 rupees that we have? This is a discount account. It is a discount account. So we have three accounts here. Jyoti's account 4,000, which we are going to settle. Cash we are going to pay is 3,800 and discount which we are paying is 200. Jyoti's account is personal account, cash account, real account, discount account is expense, so nominal account. Jyoti's account, let's apply the rule, personal account rule, what is it? Come on now, you remember it, right? Personal account rule says debit the receiver, credit the giver. Jyoti is the receiver in this case. We as a business are paying Jyoti. So amount of whatever amount we are paying is debit. Cash is what? Cash is going out from the business. Real account rule says debit what comes in, credit what goes out. Are we receiving this discount or are we paying this discount? Discount is either an expense if we are giving somebody, and discount is income if we are getting the discount. In this case, are we getting a discount or are we giving a discount? This is discount what we are receiving, isn't it? Because we are paying her less. We were supposed to pay 4,000, but we are paying Jyoti only 3,800. So we are receiving this discount, and so it is our as good as a benefit of, or in other words, we could say it's a business inward income, extra income that we have, benefit of business. So we can say income, profit, whatever you name it as, and nominal account rule says debit all expenses and losses, credit all incomes and gains. So discount, if it was expenditure, then also it is nominal. Discount, if it is received, is also nominal. But in this case, discount is received. So received discount is like an income for us, and so we are going to credit. Fine. So hope this is understood. Next one. Sixth transaction says purchased goods from Super and Company 5,000. Now you can try this. What are the two parts of this transaction? Yes, Super and Company account, right? And what are we doing? We are purchasing goods. So goods account or purchases account will be the next one. So in this case, Super account, personal account, purchases account is real account. Super and Company account, personal account, are they giving or receiving? Debit the receiver, credit the giver. So they are giving us, we are purchasing goods from Super and Company. So credit. Purchases account, goods are coming into the business. So debit. Debit what comes in, credit what goes out, right? 7th point, goods worth 800 distributed as free samples. Now what is happening here? Imagine the situation. What are you doing? you're a company and you're giving away goods as free samples. When do you give free samples? You give away free samples when you want to advertise or market your goods, correct? What is going out from the business is goods, correct? And what is happening? Why are you giving the goods? It is for the purpose of advertisement, correct? So these are the two parts. Goods account is real and advertisement account is expense, so nominal. Goods are going out, so debit what comes in, credit what goes out, credit. Advertisement account is an expense or income for us, tell me. So advertisement will be an expense. So expenses are debited. Fine. Eighth now. Next. Opened account with Bank of India by depositing rupees 10,000. So what is happening? We are opening a bank account, Bank of India account. And second one is cash account. Obviously, what are you depositing here? Cash. Opened an account by depositing 10,000. 10,000, what you'll deposit? You'll deposit cash. Bank of India is personal account. Then cash account is what? Cash account is real account, right? Bank of India personal account. Bank is receiver or giver. We are opening an account. So business is giving Bank of India. Bank of India is receiver, so debit. Cash is going out from the business. Debit what comes in, credit what goes out. So here it will be credit. Next. Next is loan taken from Shankar in cash. So now what is happening? Cash account. And Shankar is giving loan. So Shankar's loan account. Cash is real. Shankar name personal. Cash is coming in, so debit. And Shankar is the giver, so credit. Fine. Apply the rule and you will get your answer correct. Next, rent paid 500. So as I told you, we always take and make an assumption that if you are paying something and nothing is mentioned, we pay it in cash. So two accounts here involved are rent and cash. Rent account is expense, so nominal account. Cash is real account. Rent expense, so debit. Cash is coming in or going out? It is going out. So debit what comes in, credit what goes out. Next, 11th. Salary paid by check 2,000. Now here very specifically, if you see, they have given us the check is mentioned, right? So salary is paid by check. So one account is salary account. Second account, which account do we have? Which bank? We have opened an account in Bank of India. So Bank of India account. Salary account is nominal, expenditure. Bank of India is personal, right? Salary is expense, so debit. What about Bank of India? Is Bank of India giving the business money, or is business giving Bank of India money? In this case, Bank of India is giving business for what purpose? For paying salary. So bank is giving the money to business, so bank is the giver. Giver's account is always credited. And last transaction, paid LIC of Shiva 2,500 by check. So what are you paying? Life insurance, and you are paying it by bank. Now pay attention carefully to this particular part. Whenever you are talking about business transactions, you cannot actually have the business transactions and the personal transactions in the same account, right? So Shiva is the giver of capital to the business. So if Shiva pays any personal expenses from the business, it is not the business expenditure, correct? It is his personal expense, which should not be mixed in the books of accounts of business. This is where many people make a mistake. Your personal bills, your personal expenses should not be put into business. These expenditures are treated as what we call as withdrawal of capital. Capital is given, and from this capital, you're taking out some money for your own personal use. Okay. So for this, a simple example I'll give you. Just understand before we go to the final transaction. If we say business is getting capital, suppose it gets capital of 1000 from this person Shiva. Okay. Now, if today the business closes and it has to give back the money to Shiva, how much will it give? It will give 1000, right? Because Shiva gave the business 1000. If business tomorrow closes, it will give back Shiva 1000. Now, instead, in between, now what did Shiva do? Shiva said, okay, you have 1000 now. So what do you do? Instead of giving me some amount, you pay LIC, Life Insurance Corporation, some amount of 200 by check. So business, is it spending for its own purpose? No. Business is spending for on whose behalf? Shiva's behalf. So this is as good as giving money to Shiva, right? Indirectly, they are paying the amount for Shiva. So today, if the business has to give back the money to Shiva, how much should they give back? They will give 1000 minus this 200 which they paid to Life Insurance Corporation on behalf of Shiva. So what is this money paid for personal life insurance of Shiva? This is called as drawings of capital or just drawings. Fine. So hope this concept of drawings is clear. Any personal expenses will be treated as drawings. So here I'm going to write it as drawings account. And second part is what? Should I put insurance? No. You have paid it in the format of check. So Bank of India account. Drawings account is capital account, personal account, and Bank of India account is also personal account. Drawings will be debit because it is withdrawal of capital. Capital when brought in, what happens? We credit it. This time it is Shiva who is the receiver. So receiver's account is always debit. Debit the receiver, credit the giver. So Shiva is receiver. So debit. Bank of India is giver to the business. Not to Shiva, we are talking about business. Bank of India gives money to whom? To business. Business pays on behalf of Shiva, right? So Bank of India is giver, so credit. Fine. So now you can pick up any transactions happening around you. Try and split them in this manner. So this is how we do the splitting of the transactions, right? Okay, so with these two illustrations, I hope now it will be clear to you how we divide the transactions into different accounts and how these split, what we have done, the splitting of the transaction will be grouped into different accounts. We apply the golden rules of accounts and then we are going to actually find out whether that particular account in the transaction will be a debit or credit. Now, what is your self-study that you can do in this? You can take any transactions happening around you, just note down the transaction, pick it as a business transaction happening and then split it into different heads. Try to apply whether it's personal, real, nominal and find out whether it will be debit or credit. So try it on your own, you list. So in the next video, we are going to take up the journal entries, very interesting part of accounts because that again, based on whatever the types of accounts, it will go to the next first step of accounting. This is your first step of writing the actual account. So it's quite interesting. You will know based on the transactions being split and then you are going to group them into personal, real, nominal accounts, find out whether debit or credit, and then write it in a specific format, which is the journal. So you can join in to the next video of Commerce Gyan, which will be on basics of accounting part 4, which is focusing on journal entries.